Hello everyone, welcome. This is Steve Lentz. I'm with DiscoverOptions and welcome to this presentation, a special one-time presentation that's going to be recorded and archived called Becoming a Better Options Trader. And what we're going to do, and let me just switch the slides over a bit, we're going to talk about just one secret of becoming a better options trader and how it kind of blends in with the things that we offer here in our company. DiscoverOptions is committed to, the one-on-one mentoring service. We know that there's a lot of options education out there, and what we've discovered is that really, it's very seldom that you'll have someone that attends a class, reads a book, and then becomes a better options trader. We really like to integrate one-on-one mentoring with it, and we even go down all the way to the single course. You can buy a single course from us and become a better options trader just with by having someone get on the phone with you, make sure you understand the material, and walk you through some open positions even if you have those. So, what we're going to do is we're going to talk about the secret of being a better options trader. We're going to talk about what we offer in that context. Then we can take questions at the end. We could go over OptionVue. We can go over any part of the curriculum that we offer. We'd be glad to cover any of that, and I think it will be a real good few minutes well spent on your part. Now, the one true secret to being a better options trader. How can you even encapsulate the secret into one sentence or even one phrase? But when I was told that they wanted me to teach on this, I said, okay. They wanted me to, we wanted to get this information out, but also talk about just what it takes to be a better options trader. And after years of doing this, if I were to say it all in one phrase, here it is. Okay, understand fully why you are trading options. And I can hear you going, that's stupid, that's dumb. Of course I know why I'm trading options. I want to generate regular income. I want to make more money. I want this or this. No. We're going to break this down, okay, so that we can, really get right to it. First of all, understand fully. Okay, now what does that mean? Just take that simple statement, understand fully. That implies that you understand options, right? You can't understand why you're trading options if you don't understand options in the first place. And so that means covering the breadth of knowledge that it requires, and there is a learning curve to trading options. Volatility, there's the Greeks, there's just understanding the various months that trade, what they are, calls, puts, extrinsic value, intrinsic value, all that stuff is encapsulated in the phrase understand fully. All right, now why? Why are you trading options? Note here, you're not an investor, you're not investing in options, we're talking about trading options. And therein, you have some implications that are very interesting. First of all, traders make greater yields. Successful traders make greater yields than successful investors. Investors invest for the long run, 5–10% a year. They're real happy. Anything over 10 is amazing. Traders, of course, expect something greater. You're involved. It's a job. You better have better yields. Otherwise, it's not worth your time. Okay? Now, but the key here is why you're trading options. Why, the phrase why. And that's why I want to get into the next part, and that would be this: why trade options in the first place? Well, there's a number of reasons, and our curriculum covers a number of these reasons, but I just want to challenge you to really examine yourself. Why am I trading options? And when I do trade options, why do I use a certain strategy at that time? Why? Really? I mean, why not do a lot of other things besides trade options, okay? You could just hold on to your ETFs. You could do a lot of things other than trade options. But if you're a student of the market, as I know you are, otherwise you wouldn't be here, all right? And you're probably pretty smart, because option traders generally are pretty darn smart people, okay? But let's examine. I just want you to kind of look inside yourself. Why are you trading options in a certain way? So one reason to trade options is to use leverage to speculate on large, fast moves in an underlying asset like stocks, futures contracts, or indices or indexes. All right, now, and that's why a lot of us get into options in the first place. This wasn't my introduction. I got into it on another reason we'll get to in a little bit, but a lot of folks that first come into options learn about call options and put options. And hey, you think a stock's going to gap down on earnings? What can you do? Well, you could buy put options. Well, what's a put option? And so we're talking here about using leverage, and of course, if you have been through in the introduction course on options, you understand leverage, okay? You know, an option controls 100 shares of stock, etc. But here's the key. Large, fast moves, long calls and long puts, okay, are only going to work if you have a move in the correct direction that you're guessing, all right, and fast. It has to be fast. Look, if you're buying a call on a stock that you don't expect to move greater than a 1 standard deviation move to the upside, that's not the right strategy. All right? If you're buying calls on stocks that you don't expect to move up at a greater than a 1 standard deviation pace, forget about it. You're doing the wrong thing. All right? So when you go long calls and long puts, you have to do so in the context of an expected move that is quick, faster than usual. That's the other way to put it. Okay? And we cover this quite a bit in our level 1 courses. And we're going to get to the special. We bundle these, but we also are offering, if you want to just buy 1, 2, or 3 of these, you can certainly do so. Now, every course we offer, we give you an in-depth recording, we give you homework, and then you get to meet with one of our professional trading mentors. These guys are, trading and managing money on their own, and they have time in the day to do mentoring on the side as well. And they'll get on the phone with you for an hour and go over this material, go over the homework, answer all your questions. And look, if you have any open positions on at the time, you can go over those in the context of our money management models. We're not a registered investment advisor. We're not going to give personalized financial advice, but we can reference the models we have and kind of make some comparisons in an educational context, okay? Level 1 is where we talk about long calls and long puts. What strikes do you use? Okay? Which month do you use? We cover all that. You can see that that's session 2 in level 1, for example, all right? So this is one reason to trade options, and many of you might be going long calls, long puts, completely understandable, okay? But make sure that when you do so, you're expecting a large move. Again, okay, so this is just one reason to trade options. What's another reason to trade options? Okay, number 2, you can use let's see, Ron wants to know if we'll be demoing any of our tools today. Ron, I would be glad to demonstrate OptionVue. I would like to have you maybe give me some kind of direction, and I could certainly demo it for you. That would be no problem. I would love to at the end of this. I'll plan on doing that. And you might have a stock you want me to take a look at. And if you could, Ron, just tell me the symbol you want me to look at, and we'll go take a peek at the chart and the options as well. One second reason to trade options is to use them as an overlay so that you can reduce volatility and increase the yields on your long-term holdings. Now, this is one reason a lot of folks get into options is because they have a lot of long stock, and maybe they got hurt a little bit and they're looking for ways to protect their portfolio. Lots of money managers out there are using overlays of various types to do this, to reduce the volatility of the yields and to also increase the yields in the long term. And so what we do is, for the folks that, if you want to get into that, in level 1 again, we talk about a few things here. First of all, covered calls is a very important concept. If you want to do something like this with your long stocks and you want to reduce the volatility of your returns on those stocks and increase the long-term yields, you know, through bear markets and bull markets, increasing the long-term yields with reduced volatility of your returns. You want to look at covered calls and campaigning. That's what you see there in session 3. We show you how, and what we'll do is show you which calls to sell. If you have long stock, you can sell in the money, at the money, out of the money calls, and we give you a system for modulating your covered call campaign that's just outstanding. It's far better than just always selling calls that are a little out of the money or at the money. We show you how to modulate, depending on what the market conditions are. Now, look at the bottom, session 5. Protective puts, married puts, and collars. Again, we show you a modulating approach to collars where you're also buying puts to protect your stocks. All right, but look, this is a reason for trading options. Some folks get into covered calls without really focusing in on why they're doing covered calls. Is it really to reduce volatility, or is it just another trick in the bag? Okay, and one thing I want to make sure is our students understand the reasons, because a lot of folks out there, and I've been guilty of this over the years of doing this, we just throw out tricks of the bag of tricks, talk about it, and call it options educational content, and woohoo, not good. No, we have to understand why we're doing covered calls. You do covered calls because you're bullish on the stock, and you want to reduce the volatility and increase the long-term yield on that stock. Okay? And that's just another reason to get into options, is enhancing the yields. Third reason, there's 2 more. Okay? Use leverage to speculate on slower moves in the underlying asset, either up or down. Slower moves. Slower moves. What if you just kind of have a hunch a stock is going to weaken and go down about 10% over the next month or 2? All right, and you might have a study showing you that it's going to top out and pull back over the next month or 2. What can you do? But you don't know how fast it's going to go down, and that could be a problem. If you don't know how fast the stock is going to go up, you might be bullish. You just don't know if it's going to go up super fast to buy calls. What can you do if you're bullish or bearish and you're not as excited about the speed of the movement, the quickness of the movement? What can you do? Well, in level 2, we offer a series of courses here, and we bundle them all together at once if you want. This is called spread trading. This is where you're going long one option over here, selling an option over there, and capturing the spread in some way. They could be in the same months, different months, same strikes, different strikes. We teach you all that stuff, but these are called option spreads. And you can construct option spreads to take advantage of your bullishness or bearishness, all right, even if you're not excited about the speed of the movement of the underlying asset, whether you're a futures guy, a stock person, or just want to trade the indexes. And so all of level 2 is exclusively on spread trading. And this is a huge, huge reason people get involved with options, is because you know what? Going long calls and puts, how hard is it just to get direction right? Much less getting the speed of the option of the movement right. You got to be right on both direction and speed. That's tough. That can be tough. Now, you might score a few, and I've done this. I've traded long calls, long puts on trend line breakouts. Sometimes the trend line breakout works, and boy, it races through. Great. Sometimes it pulls back, wobbles around before it goes down, and, well, since it didn't go down or up fast enough, I ended up losing money. That stinks. So this is a way to get around that, to where if you're not certain about the speed, you trade option spreads. Whether it's vertical, horizontal, we show you how to do trend trading, counter trend trading. We give you some ideas on some technical analysis things here. And then there in session 6, advanced principles of directional spreads, we show you how to determine stop levels and construct a spread study to find the very best spread and make the best decision on which spread to use. Okay, so that's the third reason to trade options. There's one other reason to trade options that we really like to show people about and show you our models and how they work and everything. We show you how to use leverage, or here's a reason to trade options. One reason, and this is how I got into option trading, use leverage to speculate on lower volatility of movement in the underlying asset. This could be non-directional, and let's break that down a bit. Using leverage, that's why we're in options, all right, we can have leverage, and again, we're going to speculate. Mind you, trading at the end of the day, folks, is speculation. I love, Lawrence Livermore, the old, that famous book that was written about him. He was those guys, they considered themselves speculators. And we don't really use that term anymore today. You're a trader, a day trader, but you rarely do you hear an options trader call themselves a speculator. And that was very common 100 years ago. That's what they did. They were professional speculators, and that's what we're doing here. We're speculating on the movement of the underlying asset, and we're exploiting that speculation through various strategies. Now here, if you feel that an underlying asset is going to experience lower volatility in its price movement, you can trade non-directionally and exploit that lower volatility. All right, and we teach this in level 3 through the use of condors, calendars, and butterflies. Condors, calendars, and butterflies. And we have to show you about volatility, and that's part of level 3 as well. But this is kind of why I got into it. I had a friend who well, I guess we were both, this was back when I was in my 20s, a few decades ago. Well, how many decades? Yeah, this was about 3 decades ago. And I had a friend, and we were both in the mortgage business. Well, he was in the mortgage business. I had an appraisal fee shop. I was a real estate appraiser. And I had 1 or 2 employees helping me out, and I was working for mortgage banks doing FHA appraisals and running around and Fannie Mae appraisals and all this. And here the deal was, though, okay? If the bond market went down, interest rates went up, and people really would stop refinancing. If they had a refinance deal on the table and they didn't lock in, well, then I would have cancellation of my appraisal orders. Okay, if the bond market went up, interest rates were going down, all of a sudden people wanted to get their home refinanced, and I would be inundated with appraisal work. And it was a feast or famine existence depending on what the bond market did. And so I got to learn about the bond market there, and so my buddy then was in the same industry. He started trading the bond market, and he started selling naked strangles in the futures on the bond market. Well, and he showed me about how to do this, and this is back in the late 80s, early 90s. And he started managing money, and, the rest is history. I got interested in it, and eventually started working at OptionVue in 1998, and I've been here ever since with the DiscoverOptions. And of course, we've gone into other strategies beside naked strangles and everything, but that was my introduction to all this. And you can make money no matter which way the market goes, and you make money through the use of time decay by the erosion of time premium in the options. And this is our level 3, and this is how our mentors trade for themselves and manage money, is through these same strategies using the same principles we teach here. Okay, so these are the 4 reasons we like to cover in terms of trading options. Now, someone might say, hey, what about using leverage to speculate on higher volatility of movement in an underlying asset non-directionally? That would be buying straddles. Going, short butterflies, something like that. Now, that is a viable way to go. I would say this, that speculating on future explosive moves, I've done a lot of systems testing in options. We have in OptionVue a great back trader module that allows you to back test strategies going back to January of 2001. And I like to combine that with technical analysis. And I got to be honest, I have not yet found a system, and I'm not going to teach something really unless I know that the system behind it, you know, I can show some good viable results. And so I've explored technical analysis explosion, you know, trying to predict that. It's just that you know, maybe I haven't applied myself as much in that as these others. But until I have a system I can hang my hat on and teach that I know works, I'm not going to show it to you. I don't know. I mean, we won't go there unless it's in the bag, I guess you could say. So those are the 4 reasons, and you need to understand those to trade options and be a better trader. Now, getting more questions here. Does the back trader support futures options? Diego, absolutely. OptionVue's back trader has futures options data, historical futures options data going back to January of 2001. Okay, and so I'm getting a request for a demonstration of back trader and also do a scanner in identifying high potential trades. Ron wants to see OpScan. So let me do that. Before I get to OptionVue and show you a little demo of OptionVue, do we teach these strategies with futures options? Absolutely. That would be all wrapped up in level 5. Don't have a screenshot of that. But all of these concepts are wrapped up in futures options with using our level 5. So here's our February course special that we're running to you for February. And you can basically do, it's a 10, 20, 30 is what we're calling it. Watch this. Order any single course and you get 10% off. Anyone guess what the 20 means? 20. Order 2 courses at the same time and you get 20% off. And finally, if you were to order any 3 courses, 30% off. That's pretty much, that's almost getting a 3rd course for free. If you order 2, if you order 3, you're getting 30% off. It's pretty darn close to ordering 2 full courses, getting the 3rd one for free, just depending on which ones you get. All right? 10, 20, 30, that's for February here. You could call and talk to Karen or James. They'd be glad to talk to you. Now, maybe those of you that have called in before, you're either with Karen or with James, but give us a call and they'll walk you through this and find the courses that would really be best for you. All right, so let's see, the phone number. I didn't write this down here. I'll tell you what I'm going to do. Here we go, at the very bottom here. All right, here we go. 847-816-6610. And the 800 number is 800-733-6610. All right? Those are the 2 numbers to call. Now, let's go into the OptionVue program, okay? I had a little request to just see some stuff in OptionVue. Be glad to show you a little bit. And, okay, let me dial this up. And I'm going to share with you my desktop. And there you are. You're in my OptionVue program now. And what you have here is a quotes display. And this quotes display is highly customizable. I do a course every Wednesday morning called the Morning Market Huddle. These were some of the stocks we were looking at this last week, this last session here. And so the quotes display gives you a complete look at the underlying assets that you're interested in. And you can just type in whatever you want there. Maybe you're looking at Apple there, something like that. And it's very customizable. Now, at OptionVue, we like to go from the big picture down to the small picture. Big picture to the small picture. So this quotes display is a look at the big picture. All right? So from there, we're going to drill down to the options. And what I'm going to do is just left-click on one of the symbols we're interested in. I'm now going to double-click, and it brings up what we call our matrix. This is our matrix of option and contracts here. Now, let me explain this a little bit. All right. And maybe I can get my little annotation tool out. Very good. Let me switch colors. Perfect. There we go. All right. Now, notice a few things that are different. If you're trading through your broker's platform, you'll notice that it looks a lot different than this. And Lentz, our founder and chief software engineer, started this format way back in 1983. And it really is the best way to imagine options if you are an off-the-floor options trader. Look, a lot of these brokers will show you the options in a column with the calls on the left, puts on the right, near month at the very top, and in one big, long, huge column of options. Look, that's perfect if you are a market maker and you need to see, different combinations of options, so that you can do boxes and conversions and reversals and all that stuff. But that is not a good way to imagine the options chessboard, so to speak, if you are an off-the-floor options trader. So I'm going to show you how we like to lay these out. We have the calls at the top. These are all the call options. These are the puts on the bottom. And we want to separate them so that you can, in your mind, see, okay, calls are on the top. If the market goes up, calls make money. Okay? Puts are on the bottom. Market goes down, the puts make money. That kind of thing, all right? Now, then we go across the screen and we have the front month options on the left. And then Apple trades weeklies, so we have those going out. And here are the expiration dates. March 1st, March 8th. Here's the weekly that expires on March 15th. And then you get to the March options that expire on March 22nd. And so you can then see the horizontal relationships from month to month to month. So these at-the-money options in one series has a different implied volatility than the options going out. And in this way, you can quickly see horizontal relationships at just a glance like this. If you lay it out in a column, you can't see that. And if you like to trade calendars or diagonal spreads, seeing this format in this chessboard is just critical. It's very, very important. So let's just go ahead and drill down now to the next level of these options, okay? Let's say that you expect Apple to go up at a pretty fast pace here. Here it's pulling back a little now. Maybe you think it's going to explode into the future pretty strong. So let's come to the front month options, or the the Febs that have 8 days left, expire on February 22nd. And we're going to click here in the trade area, and I'm going to input the number of options that I want to propose buying. This is a 10 lot that we're going to propose buying, and OptionVue is today's expiration. Oh, you want to go to today's? We can go back right here. There we go. This is the ones expiring here at the end of the day. February 15th, well, that would be Saturday tomorrow, but this front one, that's the price at 126. I'm coming out here to next week's, okay? So once we propose a trade, we then click on the Analyze button above. Now, relevant to that 10 lot that you're seeing there, let me just show you quickly. The program will come down here and show you the various Greek values related to that position. If assuming that you really like to study the Greeks for the trade, that's where it's all at. Now we can factor in commissions, and we can program in the correct commissions, and also we're factoring in slippage if you so want to. We can throw slippage into this. Now we're going to click on the Analyze button here, and there it is. Now, some of you may or may not know how to read these screens. And I'll tell you, when I started getting interested in options, I saw these graphs, and I thought, oh, man, I really don't want to ascend under the learning curve, right just yet so that I have to study that stuff. I like to read about trading and about the underlying asset, and that was great for a while, but eventually I had to learn about these graphs, and you do too. If you're going to be a better options trader and you want to understand fully why you trade a certain strategy for a certain speculative outlook, you've got to understand these graphs. So here's what you're looking at here. Let me go to the annotation tool again. And this is a grid, and we have an x-axis and a y-axis. Now look carefully here. The x-axis is the price of the stock of Apple. And as Apple goes up, we move to the right. As Apple goes down, we move to the left, coming this way. All right, now the y-axis over here is your profit and loss line here. Anything above the zero break-even line is gain. Anything going underneath it is loss. Now, how do you read this chart then? Watch this. We have these different lines here. Okay? We have these different lines. These are different time frames, and you can see that all right up here. That's where the time frames are. All right, let me switch colors real quick. All right, that's red, and you can see T plus 0 is today's line, which is right here. That's T plus 0. Now notice, if today, and this is where the software comes in, if today Apple goes up to, let's see, and actually I have to click on that. Let me come over here and click on T plus 0. All right, I'm clicking on T plus 0. Let's now annotate. Perfect. Okay, so if today Apple goes up to 547.2, okay, we're going to make 44% on our money. Now, how much is this? How much money do we take to put in? That's over here. That's the amount required right there. So we're going to make a 44% yield. Now, you might want to just see the profit amount. So I'm going to come over here, change this to profit or loss, and you can see that that's $2,310. How does the program know that? All right? How does the program know that you're going to make $2,310 if Apple today goes to 547.2? All right? This is the beauty of the Black-Scholes model. Now, we've altered it a little bit. Len Yates changed it a little bit to account for some things that the original Black-Scholes model did not account for. But I'll tell you what, inclusive in that 2310, folks, we're throwing in everything, including the kitchen sink. We're throwing in slippage. We're throwing in commissions. We're throwing in likely shifts in implied volatility. That's a combination of stuff you won't see in your broker's program or really in any of our competitors that do this. All right, they do not throw in near the number of parameters that we do to try and make that number, that 2310, as accurate as possible, as accurate as we do. We have stuff going on others won't even venture to go. And you know why? It tells you why OptionVue has been around since 1983, involved in having, and we've occupied this little niche of the highest end options analytics that's available to the trading public. That's what we do. Okay, and with that, we feel that we offer the highest education that's available to the public. We have professionals that are taking time on the side to teach you. And we really don't like to teach courses and wave goodbye to you. We really want you to meet with someone that can help you truly become a better options trader. That's our MO. That we're pretty committed to that, an exclusive one-on-one session, not group sessions and all that, where people can hear you asking the questions you might think are a little dumb. No, there's no dumb question. You get one-on-one, everything's alive. You can ask anything you want. All right, so let's continue with this. Look at, there's different time frames. I can click here and go to 3 days out. The next line is showing you 5 days out. Now notice, this long call is going to lose money over the course of 5 days. If this thing doesn't move, If it only moves up to 544 in 5 days, look, I'm down $940. Remember what we said, you need the darn stock to move pretty quick. For you need a faster than a 1 standard deviation move to really warrant you buying calls or buying puts, just going long like that. Now watch this. Here's what is so great about this. You can get out of this trade, say that you don't like it, or you might want to try something else. You might say, you know what, instead of going long calls, I might want to do something like this. I might want to do a bull put spread is what it's called, and it means you're going to sell a put down here, go further out of the money and buy a put. This is called a vertical credit spread. This is taught in level 2 in our curriculum. And when you analyze this now, there you go. It looks like a completely different picture. You'll still make money if it goes up to 547. May not make as much money. But watch this. If I flip-flop, I can use these yellow arrows to flip-flop back and forth. You can see here, if the stock doesn't move much, I'm going to lose money. On the other strategy, if the stock doesn't move much, I'm still going to make money over time. Even if the stock goes down to 540 over that time, I'm still going to make a few bucks. Even if it drops $4, I'm still going to make some money here if it drops $4 over a 5-day period of time. Not bad. Now what's great here is I can superimpose these two trades on top of each other, clean it up a bit, and I can compare the two positions this way. Not only with a single line, but watch this, I can then go to one line and take them both to maybe, say I want to look at what it's like in 3 days. There it is. So the long stock is in blue in 3 days. The red is 3 days out using the bull put spread, and I can see that if the stock doesn't go up past, say 5, and I could really zero in on that a bit right there, it has to go up pretty much past 547.90 for it to warrant me buying the call instead of doing the bull put spread. You see that? So in this way, you can compare positions one to another and really come in for landing on the best decision. But again, we bring you back. Guys, why are you trading options? Why are you trading options? This long call position speaks to a completely different reason than using the bull put spread here. And I'm challenging you to get in touch with why you trade options, which approach, which part of the market are you truly speculating on. Fast moves, slow moves, lower volatility, maybe greater volatility. All right? So you have to be in touch with yourself in that respect before you come here and start analyzing like this. I had a request for some scanners, if I'm not mistaken. All right? Let's look at some scanners. Okay? One thing we can do is we can go to, well, this would beg a real good notion of, let's go to survey. Survey enables us to examine what we call volatility charts. And let me show you here. In OptionVue, we keep volatility charts on every asset that trades. And what we like to do is show the implied volatility in blue. That's the volatility implied by the price of the options. Then in red, we have the statistical, or what some would call the realized volatility. All right? Now, so the blue line shows you the price of the options, or the volatility implied by the option prices. And what we can do is scan several thousand of these charts. So let's say that you want to find just those stocks that have crazy high implied volatility. So I can come in here and I'm going to examine, I'm going to find the 1,000 stocks that have the highest implied volatility, and I'm going to sort them the same way. I want the highest implied at the top of the list when I do this scan. So let's go and just find those that have the craziest, highest level where the options are just exploding through the roof. There's clearly some anxiety over these stocks. Big fat move coming up. I'll tell a little story. My son is in college and he's in a finance class, and they have this little thing going on with the market. Little, you know, and he's never, I mean, he was in high school and college, and you know, and he's off studying accounting and never really took to the markets much. And he comes to me and says, "Dad, you know, I'm in this class, you know, and we're kind of keeping a portfolio, and you know, glad to report in just a week I'm up 10% because I picked this one stock that went up." That's pretty cool. I said, "Patrick, would you be interested in knowing about stocks that are really about to explode? Because in the options market, you can really kind of you know, look at the pricing of the options and tell which ones are going to explode on earnings and stuff. Really, what are earnings?" So I told him, you know, and all right, so I gave him a few that, you know, I knew going into earnings, the options were crazy high in the front month, and you know there's going to be a big gap. And so it's kind of like, you know, he emailed me the next day and said, "Wow, how did you do that?" You know, and it was like, well, it's not that hard once you understand option pricing going into earnings. It's easy to tell which ones are going to really gap. And so that was kind of fun. So here you have a bunch of stocks, highest implied volatility that we're scanning for. These are ones, high IVs, that are just going to, there's clearly some pending announcement, FDA stuff maybe. Maybe there's a buyout, there's earnings coming up maybe. There's a reason that these all have super high implied volatilities. But one thing's for certain, when you get into those options, and let's just go to Chelsea Therapeutics, let's just bring up that matrix. And look at this. The stock's at about $5. But the options are implying a move of a yearly move of a normal move, a 1 standard deviation move a year from now of 400%, 200%. Crazy. Look at this. This is just amazing. I mean, you have a straddle here. You have a straddle here that when you add these premiums up 1, 2, I mean, you're looking at a $2 move in the course of 8 days. Something clearly is going to happen with this stock over the next week. All right? And if it doesn't, well, then those who sell this premium are going to make out like bandits. So this is one way you can scan, is using survey. We have another way of scanning called OpScan. OpScan enables you to customize your own formula and go out there and query the entire options world using using your own special formula. So here I have a list of my special formulas, and let me just show you one. I'm looking for covered calls that have 30% in the money calls that have you know, fat yields. Here's one. Let's just see if we have any good covered rights. 30% in the money options. So calls that are in the money by 30%, greater than 20% annualized yield. Wow. Let's just see if we can get, if there's anything out there on that. But this is a formula I wrote. This is a while back. Hope it works. I just pulled that out. All right, there it is. It came in. Let's just go see what it is. And there we go. All right. So we have, well, this is, and a lot of these have really high implied volatilities, but these June 4 calls, let's go to the June 4 calls. Let's go to the calls, the 4 strike. Here we go. Let me show you. Okay. We can sell one of these, right? Oh, come on. Oh, wait a minute. Where's my trade button? Boom. June 4s over here. Trade -1. I come over here and I'm going to go long 100 shares. This is a covered call strategy, going long 100, selling one of these deep in the money calls. Presto. Let's see what the annualized yield is. That going to 376% annualized yield. And that's an option that is pretty, it's over 20% in the money. And the break even is way out here down at $2.87. It's trading at about 5. But I found that through OpScan. Now, mind you, there's a reason that these options are so expensive. So you're going to want to explore that before you jump in with both feet in your whole portfolio, right? Okay, we don't trade huge without fully understanding. Remember, fully understand, that's how we trade options, is with fully understanding what it is we're speculating on. So that's OpScan is another thing we can use for scanning. Finally, I want to show you BackTrader. I'm going to show you BackTrader here. Let me bring up, I'm just going to bring up the matrix that I showed you for Apple. Okay, let's bring that up. And what we can do is go into what we call BackTrader, and this is like a time machine. I'm going to run this back to, say I wanted to look at Tuesday's close. I can click Start, and it is going to dial back the entire OptionVue program, and it's going to update my quotes display here. It's updating all the option prices here. And what it is, it's basically now turned OptionVue into a time machine. So I can go ahead and convert this trade and walk forward in time, and I can actually now paper trade at warp speed. Okay, paper trade at warp speed using BackTrader. All right, I don't have to paper trade in real time, day by day by day, learning my lessons as we go. I can use BackTrader, go back to January of 01. I can walk through 9/11. I can walk through the summer of 2002. I can walk through the crash of 08. I could go through the flash crash in May of 11. All right, and just see how well my approach gets shock tested in these various periods of time. It's a great, great tool. Okay, so if you're at all interested in taking it to the highest level of options analytics, you're a serious options trader, and you want to go the full distance and take it to the level that the highest level you can as an off-the-floor, retail trader that's not working at an options trading firm for Goldman's or someone. This is the highest level tool you're going to get, folks. It's just, that's the way it's been since 1983. All right, so let's see if any other comments, and then we'll go back and wrap it up here. Can you have BackTrader test technical analysis setups triggering signals? Okay, Diego, I know what you're saying. It's kind of like Metastock. I use Metastock where we can look at trading signals, technical analysis signals. And the answer is no. We do not have language that you can program and then click a button and then, a few minutes later get the return levels out like you can if you're using Metastock or if you're using TradeStation or Wealth Lab or, one of those where you're just back testing on the chart. Okay, here you have historical option prices saved, but you do need to use the forward test, and you would be manually back testing using historical data. Does OptionVue support algorithm automatic trading? No, not at this time, Diego, unfortunately not at this time. Do we have real-time data with OpScan? Matt, yes, OpScan works exclusively in real-time data. It does not work in BackTrader. We do not have BackTrader working with OpScan. OpScan only works with real-time data. And so what I showed you there in that OpScan report, okay, all came from the current data. You can see I've run these a lot. This is all real time coming in, the bid on those calls, etc. Whew, boy. All right. All right, folks, thanks a lot for joining us. We're going to post this thing. I want you to call up here, talk to Karen or James, whoever you're working with, go over the courses we have. We would love to see you take advantage of our 10, 20, 30 special. I think it's something that would be really good for you to become a better options trader. Take care, folks. Have a great weekend. We'll see you later. Bye-bye.